Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is the second in a series of two webinars titled Top-Down Analysis, and we will continue talking about preparation for the trading day or trading week. Well, nothing is really guaranteed in trading, but the odds of success will be great if you take the time and analyze the market before your trading day or week starts. And in this webinar we will dig a bit deeper in the process of analyzing supply and demand captured from currency futures market. And I remind you that such analysis can be very useful for those trading on Forex market as well, because currency futures and options uncover the intentions of hedgers and other commercial traders, so that we can make conclusions about the spot market. Also, we are going to talk about important reference points on charts that can be important for either day trader or trader operating on any other time frame. All ideas discussed in this webinar were somehow used for trading either for me or students of my educational groups. Now we are getting started. And traditionally, before we start, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading, and remember that information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. And now we are ready to start. And once again, let's remember, why does it make sense to analyze futures or open interest of volume captured from futures market? And here you see again the table with two columns, and you see that first of all we have transparent information from the market concerning open interest and volume, which is unavailable on Forex market. And secondly, even if the volume is great on the spot market, we can see significant shifts in supply and demand on the futures market. So if something meaningful starts to happen on the spot market, we can see it also on the futures market. And on the interbank market we have no centralized data, and that's why we can analyze derivatives. So that is the main reason. Well, futures market is just the piece of the pie, but all important shifts are visible. And again, compare charts from futures market and the Forex market. On the left side you see the Forex currency pair, euro versus American dollar, and at the right side you see currency future for euro, and you see that charts are pretty similar, so we can analyze one chart or one market, making conclusions about the other market. In the previous webinar I was talking about COT reports and information from those reports. They can be extremely useful for trader, but the drawback of these reports is that trader can't access information in real-time mode. Every report is published late in the day on Fridays, and aggregated data shows us what was happening before Tuesday, so we have a few days of delay. But in day trading or in short-term swing trading, it is often important to see information in more detailed mode at the right side of the chart. And it is daily bulletins that can provide us such kind of information. They allow us really to see information from the previous day, and they are available from the link shown here. Also, we can access historical data of daily bulletins from FTP server, and that is very useful because we can make historical tests, compare it with charts, and it is very useful. And of course there are some drawbacks analyzing daily bulletins, because we don't see distinction between the open interest like for COT reports. We don't see who was involved, large traders, commercials, specs. We don't see how it was involved, we just see the number of open interest and volume. And that is more difficult in analysis because we have to compare it with the chart, we have to build hypothesis, and we have more uncertainty, more conflicting information, and we have to guess more than analyzing COT reports. Yet it is a very useful tool, and I will show you later in this webinar how to use it for real trading. So we can take a closer look on what is happening with open interest and volume on futures market and make conclusions about the spot market, defining the destination for our trades. Now let's go through the process of analyzing daily bulletins, and let's start with going to the website www.cmegroup.com, and the next thing we can go to the search and type in the daily bulletin here. So you see we choose daily bulletin. What do we see next? We see some sort of a list, and trading Forex we have to choose FX. FX and PG07 is what we need here. It is a report that we need for currency futures. So we have the PDF document with several columns, several instruments, and you see here that we have British Pound future, Canadian Dollar future, Euro FX future, Japanese Yen future, and Swiss franc. So we can analyze these instruments, making conclusions about the volume and open interest. For example, let's take British Pound. We have several contracts here: December 15, March 16, June, September, December 16, and March 17. And the majority of volume is traded on a March contract of 2016 because today is the day of expiration of December contract, and the open interest will decrease dramatically in this contract today, and we don't have to analyze it. To get the exact number of open interest, we have to combine these two numbers together, and we will get something around 190,000 of contracts. This information is information from the previous day, from Friday. I am recording this video on Monday 14, while this report shows us information for Friday, December 11th. And so we have seen that during this day, Friday, December 11th, we have open interest increasing for the March contract for 15,000 or so, and we have decrease in December contract of 7,000 contracts. So to get the exact number of open interest, we have to combine these two numbers together, and we get 190,000 contracts. And to get access to historical data, we have to go to the link shown here on this slide, and we get to the folder where we can download these reports. For example, we can download the one from Friday, December 11th, from Thursday, December 10th, and etc. So we can compare previous historical chart with the open interest and volume and try to figure out what was happening in the market. But before we go to the charts and see what happens there, let's go through the patterns that can show up in the bulletin. The first one is accumulation, and here we can view the exact moment of accumulation. If we see volume and open interest growing substantially while price was not showing any meaningful action, we can recognize opportunity for a momentum trade. While not every movement in the market is preceded by growth of volume and open interest, but often growth of volume and open interest is followed by a breakout or an impulse phase. So that is an opportunity for a trader, and we have to keep an eye on this situation because we have to capture this accumulation. And one important nuance, that we have to have at least 2 days of this accumulation, because it's not one single day. We have to see the continuous process. If we see the continuous process, eventually it is going to end up with a break. If volume was increasing while open interest was not changing, it can be the sign of increased intraday activity. Traders were stepping in and stepping out, in, out, in, out. They were trading all the day, but really nothing has changed. This open interest remains the same. It doesn't show any opportunities for a swing trader. Yet, if something meaningful was happening before, it is a sign for you that nothing has changed, and you can keep your positions. You can hold your positions until they reach your target. And another interesting configuration occurs when we see increased volume aligned with growing price and decreasing open interest. And vice versa, if you have descending trend, also price can go down with decreasing open interest and increasing volume. Very often it is a sign of short coverage or a long liquidation rally. Market is going in some direction without the support of higher time frames. That is why this action is weak, and we can search for a counter trend trade to get inside the trade, to get inside the market. And the best situations occur when you have the main trend, for example, directed to the downside. Then you have the correctional trend or a correctional phase, and you see that within this correctional phase you have open interest decreasing, and that is a sign of weakness. So you can search for a counter trend trade, you can capture a pullback and go in the direction of the main trend. So that is the most powerful situation that is good for this kind of setup. Now let's go to some charts and see what is happening there. For your convenience, I have combined chart of euro versus American dollar with open interest and volume from euro currency future. And many traders were asking a question about this day, about December 3rd. They were wondering what was happening within this day. Some traders, they thought that some big player or big market participant has entered the market, has pushed the market up. Others, they thought that it was just a short coverage rally. But the best way to answer this question is to go to the open interest, to go to the daily bulletin and see what was really happening there. And I suggest you to start with December 2nd and see what was happening there. I have told you in the previous webinar that we had ongoing process of accumulation lasting for about 5 weeks. Here we have December 2nd. For December 2nd, we have to search for EuroFX future. It is here. And that is open interest for this future. So we had March contract increasing for 2,000 contracts, and also December contract increasing for 1,800 contracts. So we had accumulation of 3,900 contracts for the day of December 2nd. Is it accumulation? Can it be called significant shift in supply and demand? Well, to see whether it was really accumulation or not, we have to analyze overall open interest for the whole period of several days. So it might have been an accumulation, of course, but it doesn't guarantee any breakout in this case. It doesn't guarantee anything, and we had the big day of December 3rd that followed the day of December 2nd. And let's see what was happening on December 3rd. Just a minute. Okay, that is December 3rd. Again, we are searching for Euro FX future. Here it is. And we see that open interest had decreased for December contract for 6,000 contracts, and it has increased for the March contract for 4,500 contracts. So that's not a big deal. Okay, so we had open interest decreased for 2,000 contracts. That's not a big deal in spite of 4 figures or 400 points the market was going within a day. You see the volatility is very big. Volatility is very big, while shifts in supply and demand was not very big. What am I talking about? If we could have seen decrease in open interest within the day of December 3rd, it could have been very good opportunity to go short for the next day. While we had some correctional move, but it was not very elongated, because December 3rd had not shown any decrease in open interest. If it could show us this decrease, we could say that it is just a short coverage rally and market is going to resume its downtrend. While I'm not sure that this day could have been so elongated, we could see maybe 250 pips or 200 pips to the upside, but not 400 pips. Okay, what about December 4th? What about Friday? We had non-farm payrolls release within this day, so it's pretty interesting to see what was happening within this day. Okay, let's go to this report. Let's go to EuroFX. And here are the numbers. And here we have this short coverage. We have market showing us that the December contract has decreased for 23,000 contracts, and March contract had increased just for 8,000 contracts. So we had around 15 contracts of open interest decreasing. While this decrease was not aligned with the growth of the price, and it means that it is not an opportunity for a trader. Okay, the next thing is 2 days, December 7 and December 8th. What was happening within these 2 days? I remind you that late in the day on Friday we could have an access to COT reports, but they don't tell us anything meaningful because we have information before December 1st. So all important information that followed is not available in COT report. So we have to see what was happening in the daily bulletins. First of all, we are interested in December 7th. What was happening in the day of December 7th? Okay, let's go to December 7th. December 7th. And here are the numbers. December contract had decreased for 39,000 and March contract had increased for 41,000. So we have around 2,000 of open interest increasing for this day. It is not a big deal again, but it is not decrease. It's not a big deal, but open interest was not decreasing. So it is a sign of market keeping or holding the price on achieved levels without further closing of positions. It is a neutral day after all. It is a neutral day and open interest is not decreasing, so it's a good sign. And what was happening at December 8th? Let's go to bulletin and see what was happening in this day. Again, numbers are here. And here we have already significant information. March contract had increased for 55,000 contracts, and December contract had decreased for 33 contracts. So it is a big deal. It is significant information. It is significant shift of supply and demand. We have accumulation. We have a other time frame buyer accumulating position here, or at least large number of traders accumulating positions here. We don't see in report because it might be small speculators, but they might enter the market at the same time and they might generate this open interest. So open interest is going up. Price is not going up very rapidly. It just shows us the neutral day with slightly increasing price action. And early in the day, December 9th, you can start monitoring for initiative break to enter a breakout momentum trade. For example, here we have initiative break right within this candlestick, and we have a support area right here. And you see that the day is pretty interesting, the day is pretty trendy, so we can earn something within this day just holding the position, just letting the profit run. It's pretty good momentum trade. Okay, but the foundation for this trade is accumulation occurring within the period of 2 days of December 7th and December 8th. So that is our destination for breakout momentum trade. And you see how it works? It works pretty accurately. Significant shift in supply allows us to get in the trade and to hold our position, to let our profit run, earning nice profit-loss ratio in a trade. As for December 9th, we had also increased open interest, but you see when price is going up and open interest also is going up, it is not very good opportunity because this open interest is already included in the price action, so we don't have much opportunities here. And you see that December 10th has shown us the correctional phase, so we don't have much opportunities to get in the trade either for short or the long direction. Now let's go to the next example of British pound versus American dollar. I have combined the chart of British pound with open interest from future contract for British pound here, so you can watch what was happening with open interest. And first, let's look what was happening at December 2nd, and let's open the chart. Before December 2nd, I would like to see what was happening in December 1st, but there was nothing really significant here, so open interest was not changing. As for December 2nd, shift in supply and demand was significant. Open interest had increased substantially, and I will show you these numbers. You see that the December contract had earned around 11,900 contracts. The contract for the March, well, it at least has not shown any decrease. So 11,000 contracts, it's pretty good supply and demand shift. But the price had liquidated at December 3rd. Let's see what was happening at the open interest data. Here are the numbers. Oh, sorry, I will show it so that you have opportunity to view it. Okay, so here are the numbers. We have 8,600 contracts of decrease for December contract and 4,500 of increase for March contract. So around 4,000 contracts of decrease. It is not a very big deal. So we haven't had here the very good short coverage rally, but I want you to pay attention at the day of December 2nd. Here we had open interest increasing substantially. We had 11,000 of contracts. So unsurprisingly, we have this area revisited at the next week. We have this area revisited. And let's look what was happening at December 7 and December 8th. Okay, let's go to December 7. December 7, British pound. And we have open interest increasing for around 4,000 contracts. Okay, December 7 and December 8th. As for December 8th, we had open interest also increasing for about 7,000 contracts. So you see that here we have 2 days of correction with increasing open interest. Well, it's not very good situation for trading because we don't really know the destination of accumulation. I would prefer to see sideways action to get in a trade like we have seen in the euro versus American dollar. Here we have a big question of the destination of this possible accumulation. Because if you see the euro, we don't have any destination, so the market can exit this trading range in any direction. So we can be prepared to play a breakout momentum trade to the short or to the long direction. Here market has emerged from this range to the upside, so we were ready to get in a long trade. As for British pound, we don't see the destination, we just see correction. It is not very good situation for trading. Yet the significant open interest in December 2nd has shown us that this area could have been revisited, and we see this revisited December 8th. And I want you to show interesting setup that I had captured in November. It is the day of November 19th. It is the day of November 19th. And if we go to the daily bulletin of the day of November 19th, I will show you it right in 2 minutes. It is British pound as well. I want you to pay attention that open interest had decreased for 4,900 contracts here, so it is a pretty significant shift regarding the fact that market was going up, that price action was going up. Also, we had seen some anomaly on COT reports before, that market was being accumulated on the short side by large traders, but price was going up. It is an anomaly because large traders try to accumulate position in the direction of the trend. In this case, possibly the market was going to generate a shakeout to collect stops and then go back to the previous extreme. So that's pretty good trade location. So you can start monitoring for the price action to establish a short position early in the day or early in the American session and hold this position for 2 or 3 days to achieve the target of previous low. That's how it works. Now let's talk about some chart analysis, because in our top-down analysis we start with fundamental information, we go to COT reports, to daily bulletins, and after that we examine our charts. And the first important reference point that we have to keep in mind is extreme. The behavior of the market near important extremes can show us possible participation of other time frame buyers or sellers. Here is the daily chart of American dollar versus Canadian dollar, and you see that price was leaning to the upper side of this chart, but there was no test of previous extreme. And that is important information that probably large time frame is not in the game yet. market has not reached any important areas, because once market breaks out the extreme, once it achieves the area above the extreme, the auction may be over, because some responsive action, some responsive volume steps in the market. If the market leans to the upper or to the lower side of the extreme but never touches it, I would say that this market is being overbought, like it is shown here, or it is going to break the extreme. In case market is overbought, it is going to initiate a liquidation break to the downside. If it doesn't show any liquidation breaks, if it continues going sideways, the odds of the breakout to the upside are increasing substantially. So we can see the breakout to the upside. Now let's look what really has happened on the chart of Canadian dollar. We have seen the market leaning to the upper side of this range, and it is not going to liquidate. This sideways structure continues to go sideways, and we see no liquidation break. If we have seen liquidation break, we could say that okay, this price action to the upside was indication of low time frames involved in the game, and they have accumulated some inventory and they liquidated, and market is becoming more neutral. But in this case we have elongation, market goes sideways, nothing happens, so possibly it is preparation for the break. And you see what happens? Market is ready to emerge from this range, to get outside this range. Once the market breaks the important extreme, large time frames are involved in the game, so we see larger time frames involved in the game. So we can enter a position in the point 1 and exit a position in the point 2 somewhere here, or at least we can enter a position somewhere in the point A, let's say, and exit a position in the point B. Okay, and another example is from Euro versus American dollar. I want you to pay attention that historical extreme that was established in March of 2015 was not achieved, and the market had liquidated before. So market was leaning to the lower side, but finally it has liquidated to the upside. So it was not ready to build a structure at the lower side and finally break out to the downside. If we had if we had the sideways action like for Canadian dollar, for a while market was going to go sideways, finally it could have broken out to the downside, but in this case it just liquidated to the upside. So extremes are important reference points that we have to keep in mind doing our top-down analysis. Okay, in next webinars we'll continue talking about some elements of top-down analysis as well as chart analysis. And I want to remind you the process, the checklist. First we see fundamental information, then we switch to analysis of supply and demand, then we go to the charts, and finally we search for the trade location. We analyze market conditions, we search for the entry point, we set our stop loss, and that is a process of finding a good trade. The preparation for the trading day, in a nutshell, looks like I have described above. Okay, thank you for watching this webinar. In the next webinar we will continue talking about interesting information about trading. We will talk about chart analysis, and you will have some questions possibly. You can leave them below this video. I will do my best to give all the answers to all your questions. Please be specific in your questions to receive a good answer. Good luck, and see you in the next video.